talked about. What these orange bars show is that a lot of the U.S. tight oil will break even, $50 to $60 a barrel. There's a lot of variation in those numbers, of course. But that's the challenge for the Saudis, right? That's why they can't have the total price wars. They really need to keep prices below 50 for a long period of time. And if you go back to my budget numbers, that's a very expensive and risky thing for them to do. So I think they'll be content with slowing down U.S. supply, but then start to look at their own budgetary needs again in 2016, which suggests that $16 barrel scenario. Oil sands, we can talk a lot about this. There's a lot of expertise here in the room, but essentially we see growth continuing through 2018, and then obviously the slowdown in final investment decisions creates a potential gap in supply at that point. That does change perspective on some of these pipeline debates, maybe a little bit less urgency, but obviously longer term the industry will still need it. Key driver to consider here. Overall, I don't think demand is a big part of the story. It's mostly the supply story, but I do want to talk about demand briefly. What we've seen here is more and more pessimistic expectations about the non-OECD countries, the emerging markets, right? The expectation that growth is in the emerging markets will offset slowdown in the developed markets. But in fact, growth is growing, but it's not dramatic. It's still pretty flat, and it's mostly in China and a few other countries. And it's not enough on its own to really rebalance this market that we're in today. China, often considered the crude oil buyer of last resort, right? That when prices are low and there's barrels out there, they're going to stockpile as much as they can. I think that's true. Right? I think that this year, China will probably stockpile around 400,000 barrels a day. Some goes into government stocks, some goes into commercial stocks. But essentially, they're borrowing from future demand when they do that. Right? That's not real demand, that's just stock building. Overall, the growth picture for real demand in the real economy in China is slowing. Right? If we look what's happened in China since 2010, oil demand is decelerating. It's still growing year over year, but not at the pace it was from 2004 to 2010. Mostly, this is about the overall slowdown in the Chinese economy. The new normal of annual GDP growth at 7%, rather than 9 or 9.5%, but also about more focus on the environment and public policy measures to slow down oil consumption, especially the transport sector. Right? And some of those are having some success.